Hello and welcome back to the fifth video dealing with acquisition of plant assets. In this example, we're looking at self-constructed assets where a company has incurred debt in the process of constructing the asset, and the question is how much of that interest should be capitalized. So let's take a look at this exercise and see how we would work through this kind of a situation. So in this example, we have at December 31st, 2019, Main Inc. has borrowed $3 million at 12% payable annually to finance the construction of a new building. So we're constructing a new building. This is a loan that we've taken specifically for this purpose. In May 2020, the company made the following expenditures related to this building. On March 1st, $360,000, June 1st, $600,000, July 1st, $1.5 million, December 1st, $1.5 million. The building was completed on Feb 2021. Additional information is provided as follows. They've given us that there are two general debts outstanding. One is $4 million and the other is $1.6 million. We incurred on March 1st, 2020, expenditures included land cost of $150,000. That has nothing to do with building, that's land. And interest revenue earned in 2020 is $49,000. So we've been asked to calculate how much of this interest should be capitalized to the cost of the construction of the building, and the journal entry that we would need. So there's lots of information provided over here, and let's see how we're going to work our way through all this information. So the very first thing we need to do is we need to calculate what's called a weighted average expenditure. We've incurred expenditures throughout the year, and we need to find out what the weighted amount is, basically the average amount. So for this, let me show you my column headings, how I'm going to set this up. I have the dates when the expenses were incurred and the amounts incurred. That's fairly simple. I can copy that down over here. On March 1st, June 1st, July 1st, and December 1st. I have four times I've incurred expenditures. The total is $3.96 million. Now the question is, what is the relevant period that I'm going to use? So in this case, I borrowed money on December 31st, 2019, but I didn't start using that money, spending that money until March 1st. So I need to really look at only for, if I had to borrow money on this day and spend the money, what would the relevant period be? The relevant period is only 10 months. March 1st through December 31st is 10 months. So let's do the same for the next three. June 1st through December 31st is going to be a total of 7 months. July 1st onwards is going to be 6 months. December 1st through December 31st obviously is just 1 month. So now the weighted average expenditure is calculated as the amount, which is $360,000 multiplied by 10 over 12. That's a fraction. 10 over 12 is the number of months that I had the money that had been spent. That's a weighted amount. So in the first case, it's going to be $300,000. That is 360 times 10 over 12. Similarly, 600,000 times 7 over 12 is going to give me 350,000. I do a similar calculation for the next two, and I come up with a weighted average expenditure of $1,525,000. This is the weighted average expenditure. Now, what we're looking at over here in this case is I borrowed $3 million. The weighted average expenditure is less than that $3 million. So it's actually fairly easy in terms of how I would finish out the problem, but I'm going to go through the motions of showing you a few more calculations in case that number was different. Okay, so what else do I need to do? I need to calculate the actual interest, because whatever my weighted average calculations are, the people who've loaned me the money, they don't care about that. What do they care about? Getting paid. Okay, so let's take a look at what I need to do for that particular aspect of the accounting here. What are the amounts that I have outstanding? 3 million, 4 million, and 1.6 million. 3 million is specific to this construction. The 5.6, they are general debt. This was monies that I had already borrowed some time back, and I'm using it for various reasons. Okay, however, I do need all of those amounts over here. So I have the 3 million, the 5.6, and as you see, I've kept them separate over here, and I'll tell you why. The interest rate is 12%, 13, and 10% respectively. So let me write the interest rates over here. The interest paid is simply, since it's for the full year, it's simply an extension, 3 million times 12%, 4 million times 13%, 1.6 million times 10%. And then I see how much interest I paid for the specific debt and how much interest I paid for the general debt. And here I've just identified what type of debt it is. This is specific to the construction on hand, and these two are general debts. I already have those in my books, and I could use the money for whatever reason unless I've been told I'm not allowed to use that money for this particular reason. Now again, to remember, to keep in mind, the weighted average expenditure is less than the $3 million I borrowed. So I don't need to do this next calculation I'm going to show you, but I would like to show you the calculation so that you know how to work through with it. So if I was asked, what is the weighted average interest rate? Weighted average interest rate is interest paid on the general debt divided by the total debt that I have. Okay, so in this case, my general debt is 5.6 million. The interest on that is 680,000. So the weighted average interest rate is 12.14%. That's a weighted average interest rate. Now, if this amount was in excess of $3 million, what I would do is, let's say, for instance, if this was just coming up with a number, $4 million, on $3 million, I would calculate 12%. On the remaining $1 million, I will use 12.14%. That's a weighted average. Basically saying, I don't know which of these two loans the money was used, the extra million was financed, so I calculate the weighted average. But again, in this particular case, I don't have to worry about it. I'm just showing you the calculation so you know how to deal with this. Okay. Now, the weighted average expenditure multiplied by the specific debt will give me the avoidable interest. Okay, so the weighted average, that's a number over here, what we've done. I'm going to highlight that number here. The weighted average average expenditure times the specific debt, since it is below the $3 million that I already had borrowed for this project. That's the avoidable interest. Okay. What's the total interest I paid? I paid 360 plus 680. That's the total interest that I've paid. So this number over here, what I have is the actual interest paid. That's how much cash I have paid out. This is the avoidable interest. Okay, this is basically saying if I had not borrowed the money and I had not done this project, I would not incur this. This is the avoidable portion of the debt that we have over here. Now, which one should I capitalize? So the concern over here is, what amount should I capitalize to building? I always will choose the smaller of the two numbers. My actual interest is 1,040,000. Avoidable interest is 183. So this is the amount that needs to be capitalized. So let me do my journal entry and show you what that's going to look like. Well, to start with, I have the date. On December 31st, 2020, the account I have is building debit. Okay, I have interest expense debit and cash credit. Which one do we know for sure? Well, the cash credit I know. I paid 1,040,000. That's the actual interest paid. Can't get around that part. The question is, how much of it should be capitalized and how much of it should be expensed? We already said the smaller of the two amounts is going to be capitalized. So in this case, 183,000 of that 1,040,000 will be capitalized. The remainder is going to be expensed. We assume it was used for something else and we're going to expense it. So only the portion that was used towards financing the self-construction of this building, that gets capitalized to building. Otherwise, if I put this entire 1.4 million or $1,040,000 into building, that's misrepresenting the building. I'm capitalizing a larger amount. I'll be understating expense in the current period. So again, lots of implications with how we calculate the value of the building. So the building cost, as you've seen in previous exercises, is all monies that we spend in terms of constructing the building, the work starting from excavation. From that point onwards, when I start getting the work ready, all the interest incurred that has to be capitalized over here. If it is specific to the debt, I need to look for that information first. And in a lot of cases, the company may not have that at all. They just have the general debt, in which case you need to calculate this weighted average interest rate. So if the company did not have specific debt, if let's say, for instance, even this was general, then we take all these numbers and calculate the weighted average rate. So this is another example of valuation of an asset, all the items that get capitalized. This is interest capitalization, and it is a very important aspect of self-constructed assets in particular. So with that, I will end this video, and the next one, we're going to start looking at the exchange of an asset for another asset and how we will do the journal entries in different situations.